welcome to this live session on the economic outlook for India. India is emerging from the COVID-19 third wave. Economic normalization across indicators is seen. But as we are moving towards a broader growth recovery, we now are facing rising inflation, surging crude oil prices, high interest rate scenario, and adding to this, the US-Russia standoff over Ukraine. Is the India's nascent economic rebound at risk? To what extent will the external geopolitical and economic shock impact India? To talk on all this and more, joining me is Mr. Prasenjit Basu, Chief Economist at ICICI Securities. Mr. Basu has 30 years of experience analyzing Asian economies. He was Chief Economist for Southeast Asia and India at Credit Suisse First Boston and Chief Asia Economist at Daiwa Securities for 5 years each. Mr. Basu's book, Asia Reborn, An Economic and Political History of All of Asia Over the Past 2 Centuries, won the first book award for non-fiction at the Tata Literature Mumbai Lit Fest 2018. Welcome, Mr. Basu.
Thank you.
Mr. Basu, let's start with a burning topic. The Ukraine crisis are escalating. How do you see US-Russia standoff over Ukraine and the rising fear of Russian invasion impacting Asian economies, including India, in short to medium term?
Well, I think Russia has been very clear that any former member of the USSR, any part of the USSR should not join NATO. And President Putin has been citing the fact that in February 1990, the then US Secretary of State, Jim Baker, promised his Soviet counterpart that there would be no expansion, not an inch of expansion eastwards of NATO.
Okay.
So given that, since then, since 1999, we've had every single member of the Warsaw Pact join NATO. And in 2008, when there was speculation that Georgia, a former part of the Russian Empire before the First World War and of the USSR. In fact, Stalin, the Soviet leader himself, was Georgian. When Georgia spoke of wanting to join NATO, Russia invaded 2 parts of Georgia, Abkhazia and South Ossetia. And so I think Russia is very serious that right now it wants a security guarantee from NATO and from the US, abjuring any desire for NATO to ever admit Ukraine, given that Ukraine and Russia, in Putin's view, have been part of the same country for about 1,000 years.
Right.
And, historically, it is true that for 800 of the last 1,000 years, the territory of Ukraine was part of Russia, or sometimes Russia was part of Ukraine. In Kievan Rus, the original heart of the South Slavic Empire, over 1,000 years ago. So, given that historic factor, and given the fact that Russia has a real fear of being invaded through its land borders, it's been invaded by Napoleon in the 19th century, by Hitler in the 20th century. And the big buffer zone of the big land buffer that Ukraine and Belarus presented from the Russian heartland was one of the important reasons why Russia was able to defeat those invasions by Napoleon and Hitler. And so the idea of nuclear weapons being stationed on Russia's borders in Ukraine is something that is extremely unpalatable, and in fact is something that Russia is not going to stand for, and therefore is likely to try and prevent in any way it can. So we started seeing some of that action happen. In 2014, of course, Russia annexed Crimea, where the Black Sea Fleet, Russia's main naval fleet, the Black Sea Fleet, is housed at Sevastopol, the key port in Crimea. So it annexed that. And of course, it has yesterday, Russia has recognized the Luhansk and Donetsk republics in the east of Ukraine as being independent from Ukraine, that I think increases the risks of war and of a potential full-scale invasion of Ukraine by Russia. The impact of that is going to be quite negative on the world economy if indeed Russia invades Ukraine and the United States imposes swinging sanctions against Russia. The impact will be very severe, especially for Europe. Germany, for the last 50 years, Germany has got almost all its natural gas from Russia. German homes are lighted with the gas that comes from Russia. And if electricity is to be kept on in German homes and actually in homes in places like France, Italy, Austria, and the Netherlands, then access to Russian gas is essential. Now, some of those countries have alternative sources. Germany has nuclear power. So Germany's problem is that Germany wants to close down its nuclear plants, particularly because the Green Party is the second largest party in the ruling coalition in Germany. And the Greens are very unhappy about the presence of nuclear power, and they want to close those down. Given that fact, Germany becomes even more dependent on the natural gas coming from Russia. And in order to keep homes lit up during the winter months and heated during the winter months, Germany will be obliged to shut down electricity supply to some of its industries. And that will have a crippling impact on European economies, particularly Germany, of course, but also many of its neighboring countries, the ones I mentioned previously. And that is going to be quite negative in some ways for India, because the EU, the European Union, is the single largest trading partner of India, single largest market for Indian exports.
Right.
But if you get a supply shock in the European Union, then interestingly, it is quite likely that Europe will need to import many of the manufactured goods that it otherwise produces. So it may have to import, say, steel, engineering goods, the sorts of things that Europe normally exports are things that actually India produces and exports a lot of. So it's quite conceivable that the impact on the Indian economy, ironically, could be somewhat positive because last year we had a spectacular performance by India's export sector. India's exports were up 41.6% in the calendar year 2021. Mm-hmm. And the strength of exports continued in January. So we're likely to continue to see some demand for many of the things that India exports, given that European industry might be temporarily at least crippled by the absence of power arising from potential sanctions imposed by the United States. Now, the potentially crippling impact is one of the reasons why the European countries, the Franco-German axis, as it's called, it was quite reluctant to press very strongly for sanctions against Russia. They were trying to use diplomacy, and particularly the so-called Normandy process to revive the Minsk Accords, and particularly the second Minsk Accord from 2015 to deal with the East Ukrainian regions that want to secede. Now, unfortunately, that process is more or less dead as of last night, with President Putin recognizing the independence of those two republics. So that's one negative impact. The second negative, that's the first impact. Some of it is negative, given that Europe is the largest source of India's largest market for India's exports. But ironically, India could well be an alternative source of supply. So if anything, when I look at the pluses and minuses, it's probably a positive, ironically so, for India. Now, in terms of Russian exports of oil and gas, interestingly, India accounts for less than 1% of Russia's oil exports. Russia produces very heavy crudes, which are which cannot be processed by most of India's refineries. And so India doesn't import very much oil or gas from Russia. But of course, if there are sanctions on Russian exports of oil and gas, then there will be a big negative impact on the supply of oil and gas to the world. Russia exports about 5 million barrels per day, and it accounts for about 11% of world exports of crude oil. It accounts for a substantial amount of, it is the world's largest exporter of natural gas. And, so sanctions against Russia will have a very negative impact on supply of crude oil, and consequently will cause prices to rise. And we already saw the action last night has already taken crude oil, the Brent price, to around $97 a barrel. And if sanctions are imposed, I would expect that the Brent price will settle at 110 to 120 for a while. Now, the interesting thing, there are two aspects to this. One is, if you have 110, 120 Brent price, that is going to be negative for India. India's headline inflation numbers will be higher for longer. I mean, for the next few months, there will be, February, March, April, headline inflation will be a lot higher than we would normally have expected. And that could put some pressure on the RBI to tighten policy earlier than we were expecting. We were expecting, under normal circumstances, that there would be really no need for the RBI to tighten policy until about August.
Okay.
But with this sort of spurt in oil prices, it may become necessary to have an earlier rate hike. Now, I think it's important to understand a few things. If the Brent price stays above $60 a barrel for a protracted period, then shale oil supply in the United States becomes much more viable. And we have now had a year and 2 weeks of the Brent price being above $60 a barrel already. We've had 6 months of the Brent price being above $75 a barrel now.
Right.
Which means that there is probably a significant revival of shale oil production and investment occurring in the United States. The United States is now the world's largest producer of oil, and it is becoming a significant net exporter. If shale revives, as it will, if you have 1 year, we've already had 1 year of above $60 Brent price, then you're going to get a real revival of shale production, and that will substitute for Russian production to a great extent over the next few months. And the higher oil prices stay, the quicker you'll get this investment coming in. Now, interestingly about shale, about 60% of the shale oil that is fractured or fracked gets, has to be extracted within the first year. So 60% of what is fracked gets extracted within the first year. So it's a constant investment race. You have to keep investing because 60% gets used up, and the rest gets used up within the second year. So you need to keep investing to keep new supplies coming through. And so it requires a lot of credit. It requires a lot of investment. And of course, it requires the headline price to stay high. So if prices stay above $60 for a protracted period, as they already have, then you're going to get a substantial increase. Now, the other thing is, potentially, the Iran nuclear deal could well be revived within the next month or two as well.
Yes.
Now, if you look at Iran's oil supply, it had come down to 2.5 million barrels per day. Before 2018, before the sanctions were reimposed on Iran was producing about 4 million barrels per day. So if Iran returns to the oil market, you could well get another 1.5 million barrels per day of oil from Iran. So I would expect that this period of very high oil prices will be quite limited. It probably will last maybe 3 or 4 months.
Okay.
But thereafter, prices could well quickly plummet from this $110, $120 range in the next couple of months to about 60 or even lower by about August this year. Because there'll be so much supply coming on potentially. And of course, there could be some leakage from the Russian sanctions. I mean, I think even after sanctions, there'll be some customers of Russian oil and gas who will continue to buy. For instance, Belarus and China. Belarus takes about 7 or 8% of Russia's oil and about the same proportion of Russia's gas. China takes 31% of Russia's crude oil exports. Those two will probably continue to import crude oil from Russia. And so, Russian output will not vanish altogether. There'll obviously be some smuggling and so on. So, I think we could well see oil prices come down quite quickly. So, so the impact on India of this, basically near term negative. Now, there is, of course, another mechanism that India has to mitigate the impact of higher oil prices, and that is to cut the excise duties on petrol and diesel. So if they could do that primarily because government revenues are booming at the moment. So if you look at government revenue in the first 9 months of the fiscal year, FY22, government revenues were up, revenue receipts were up nearly 50% year on year. And they were, by December, 97% of the budgeted revenue receipts for this fiscal year were already in. So there actually is a lot of room for maneuver on the tax front for India to lower, some of the taxes and the potential area. The first one I would suggest is excise duties on petrol and diesel. Lower those, and don't necessarily do it permanently. If oil prices fall, then you could raise them again. The important point is that the duty, the revenue receipts are still going to be higher given that oil prices are so high. If you have very high oil price and you're taxing that, a percentage of that, then you get substantial revenue. So they could cut the tax and still be collecting quite a lot of revenue. So, but the important point is that given the overall strength of revenue receipts, corporate tax revenue is very strong, personal income tax revenue is very strong, GST revenue is very strong. The three main, and of course, customs revenue is also very strong. So all the main sources of government revenue, tax revenue receipts are doing very well. There is therefore room to cut the excise duty on petrol and diesel as a short-term measure to mitigate the impact of very high global crude prices.
Why have central banks gone so wrong on inflation this time? Because, having said that, inflation for Asian countries is still manageable. I mean, they are still being able to manage it well. While if we talk about US or we talk about European zone, the inflations are a decade high and 40 years high. So where did we go wrong? I mean, we have been trying to say that inflation is transitory, it will go off, it is supply side constraint. So what actually is happening?
No, completely, this talk of inflation being transitory, being because of supply factors, etc., is complete rubbish in my view. Because if you look at what has happened to US money supply growth, M2 or money supply, in the 60 years to February 2020, 60-year period, there was not a single month in those 60 years in which M2 grew more than 10.5% year on year. Not 1 month.
Okay.
Since March 2020, there has not been a single month in which M2 growth in the US has been less than 11%. And 11% is the lowest. It was January 2022 was just over 11.5%. every month. Now, from April 2020 to March 2021, every month, M2 growth was over 20%. It was actually over 24% throughout that period. So it is more than double the highest M2 growth, money supply growth, that has ever occurred in the 60 years before this. And it continues for the entire 12-month period and then for a further 10 months. So essentially for 22 months now, we've had exceptionally rapid monetary growth in the US. And if you have such rapid monetary growth, you will eventually get inflation, especially when the labor market becomes relatively tight. And if you look at the US now, the unemployment rate has been 4% or lower for 3 months. 4% unemployment in the United States is considered full employment, more or less full employment. So if you have more or less full employment, and yet you've got monetary growth surging at unprecedented highs, you will get inflation. So I think there's no mystery. The only mystery is, why were central banks not even bothering to look at monetary growth? I mean, this is absolute basics. Now, interestingly, if you look at 2008-9, people say that, oh, there was very rapid monetary growth then. No, there wasn't. The central bank was printing a lot of money in 2008, 9, 10, 11, 12, actually. The QE1, 2, 3. But while the central bank was printing a lot of money, most of that money was kept in the vaults of commercial banks. Commercial banks were not lending the money out. So central bank just prints money. The commercial banks must then lend it out in order to create what is called the money multiplier. If commercial banks hold the newly created money in their reserve, then you're going to have a depressed money multiplier, and broad money growth is going to be much more modest. And that is what happened in 2008, 9, 10, 11, 12. In fact, in the entire period from 2008 September, when the GFC started, until the end of 2019, nearly 11-year period, over that period, there were just 3 months in which inflation was, actually 4 months in which inflation was above 10, in which M2 growth was above 10%. Just 4 months. And it briefly stayed there and came down again, because the money multiplier had been depressed by the fact that central banks, commercial banks had become very, very conservative. They were holding on to excess reserves. And so you didn't have central bank money being converted into broad money supply at the sort of pace that we've had now. Now banks are functioning normally. And so the money created by the central bank, the newly printed money, is circulating rapidly and is therefore leading to inflation. So it's a simple issue. Now, if you remember, the reason why you had to do QE2 was that inflation then was almost zero. You were getting close to deflationary territory. And so the central bank had to come in again and do QE2 and then QE3. This time around, inflation never really went down to those extreme levels. The disruption to the economy really lasted 2 or 3 months. The really severe disruption lasted 2 or 3 months. The labor market did take about a year and a half to recover fully in the US, no doubt about it. But there was no need to continue to aggressively add to the central bank's balance sheet at the pace at which the US has been doing. And in fact, ironically, they call it taper. But even this month, the US has added $30 billion of securities to its balance sheet this month, in the month of February 2022. So they call it taper, but it's still an increase in the size of the balance sheet. And it's not required anymore. The economy grew 5.7% last year. Labor market is completely, has achieved more or less full employment. So what is the need for this aggressive monetary expansion to persist? I think it's just a terrible policy error, nothing more. Now, On the other hand, if you look at India, what is interesting is that if you look at India's experience over the last 30 years, average M3, in India, M3 is almost exactly the same concept as US M2. Okay. Now, because in India, M2 is only demand and current deposits and savings deposits. That's M2. That's actually still quite narrow money. Our concept of M3 is almost exactly what the US concept of M2 is. Now, you look at M3 growth in India. M3 growth in India over the last 30 years has averaged about 19%. And currently, over the last, during the pandemic period, there was not a single month in which it got anywhere near 19%. So in fact, if anything, India had the opposite. India monetary policy, if anything, or money supply growth was below normal. And in fact, it decelerated during much of this period. So there was no extraordinary accommodation in India. Instead of, there's no extraordinary accommodation that must now be rolled back like there must be in the US. The US needs to roll back its extraordinary accommodation. In India's case, monetary policy was actually relatively moderate during this period. It was mildly accommodative at best, but relative to India's own history, it was not particularly accommodative, because if you look at India's inflationary history, even in the 91 to 96 period, inflation was nearly 10% a year. In the period from 2009 to 2014, inflation was over 10% a year. Since 2014, inflation has been a lot milder, and we now talk of 6% as being the target rate below which inflation must be retained. I think it's worth remembering that when Raghuram Rajan became RBI governor, his target was to hit a 6% inflation rate in 3 years, because until then, inflation had been averaging 10%, more than 10%, for 5 years. So he wanted to get it down to 6%. Within the first year, it already came down to 6%. By the end of 2014, it was already down to 6%. And then they changed the target to 4 to 6. So 6% was then considered to be the sort of holy grail, but that was easily achieved. So if anything, India's inflation experience in recent times has been much more moderate, and therefore there isn't that much room or need for an aggressive tightening. However, having said all this, the Ukraine factor, the potential sanctions, and the impact of persistently higher oil prices could put some pressure in the near term, unfortunately, for the RBI to tighten, even though it's not really required for other reasons. And so I think the way to avoid that would be to reduce excise duties temporarily on petrol and diesel. If you do that, then the headline inflation numbers will not go up that much.
If that's the case, Mr. Basu, then can we say that the kind of aggressive rate hike that we're expecting for the US subcontinent or from the Fed would not be the case for India?
No, I expect that, under normal circumstances, had there not been this oil price factor in the near term, I would have expected that this year we'll only get 2 rate hikes from India. Inflation would normally have moderated in the April to July period, because you had a very high base from last year. Relative to that, there'd be fewer disruptions now that by the end of next month, I expect that about 90% of Indian adults would have been double vaccinated, and so the possibility of a 4th wave is relatively low. And even if there is a 4th wave, God forbid, then it will be a milder wave, in the sense that, like the 3rd wave, the number of deaths will not spiral upwards, and so it is likely to be much less disruptive to the economy. And if there are fewer disruptions on the supply side, I mean, essentially in India, it was supply bottlenecks in the 1st and 2nd wave that caused inflation to spike upward. This year, that recur, and consequently there is scope for inflation to moderate in April to July under normal circumstances. Also, we're likely to get a very good Rabi crop that should contribute to dampening food prices as well, and so April to July under normal circumstances would have seen inflation get down to about the 4.5% mark or slightly lower for the CPI, and allow the RBI to stay on the sidelines. So now, I do think that August to December, there'll be a little bit more upward pressure. There will also be pressure from the US tightening. When the US is tightening, all others need to tighten a bit as well. But I emphasize that unlike 2013, in 2013, when we had the so-called taper tantrum, India was among the fragile five. India was among the fragile five because at that point, the current account deficit was nearly 5% of GDP. In fact, FY 2013, the current account deficit was 5% of GDP. In the 4 quarters ending September 2013, that is the first half of FY 2014, it was still 5% of GDP. The 4 quarters to September was still 5% of GDP current account deficit. That is the highest current account deficit that modern India has had. We don't know about ancient times, but there was no measure of current account in those days. But modern India has never had a current account deficit that is higher than 5% of GDP. So if you have such a high current account deficit at a time when you have fears of a tightening of policy by the major central banks, then you're going to have pressure on the rupee. And in fact, India had 2 episodes of 15% depreciation of the rupee in 2011 and 2013 because of the very large current account deficit in both times. In the current fiscal year, in the 12 months to September last year, the current account deficit was just 0.4% of GDP, yes. Negligible. In the current quarter, January to March, I think there'll be a small current account surplus. So there is really much less pressure. Also, if you look at India's foreign reserves, in the 5 years to 2008 to 2013, India's foreign exchange reserves were flat, in fact, down slightly over that 5-year period. Over the last 2 years, India's foreign exchange reserves are up by 33%. They're up at about $635 billion US dollars, and they're up 35% in the last 2 years. So during the pandemic years, India's foreign exchange reserves have just boomed. And so there is a lot of external sector strength that will provide a buffer against becoming succumbing to any sort of taper tantrum this time. I don't think there will be any serious taper tantrum in India's case. The external balances are strong. And if anything, India will attract more capital inflow given that relative strength of the external sector.
Mr. Basu, what are your expectations for the FOMC March meeting that everybody is eyeing now? What is that you're expecting? An aggressive rate hike of 50 bips or 25 bips? And then how many times would the Fed really resort for rate increase in 2022?
Well, I think that the Fed will have to raise rates at almost every meeting. So I'd expect that they'll raise by 25 basis points at their next meeting. To try and regularize things, perhaps at the next meeting, they could do a 12.5 basis point hike. Because now, see, if you look at the interesting rate position now, there isn't a target rate, there is a target range. So the current range is 0 to 0.25%. Right. So in effect, it is a 0.125% effective target. Middle of the target range is 0.125%. So that causes some confusion. I think it might be easier to do a 25 basis point hike in March. At the next meeting, 6 weeks thereafter, perhaps 12.5 basis points. so that you take it to an interest rate of 0.5. The Fed funds rate goes to 0.5. And then I would expect at least another 3 rate hikes in the course of the year, perhaps more, but at a minimum, 3 more rate hikes in the course of the year. Markets, of course, I was saying this at the start of the year. At that time, I was considered to be a little bit ahead of the curve and a bit aggressive. Now the markets have quickly caught up, and now the markets are expecting 5 to maybe closer to 6 rate hikes. And I think that's quite reasonable, given that inflation continues to stay extremely high and elevated, and this is not transitory. It is a serious inflationary episode caused by extremely rapid monetary growth.
In that case, what happens to the bond market?
Well, we've already seen bond yields edging higher. The interesting thing is that they're just edging higher at the moment. I would expect that in the course of the next few months, we're going to see a little bit more of a steepening of the yield curve, given that the economy is growing rapidly in the US. The labor market is tight. Wage inflation is beginning to pick up. So, it's now a classic wage price spiral. It's not just headline inflation, but even wages are beginning to rise. And so I would expect to see some steepening of the curve in the US. And of course, if there is a European recession at the same time, then that provides a little bit of noise. It kind of adds a little bit of noise to the bond market, and actually kind of allows a little bit of freedom, get out of jail card, so to speak, for the Fed, because they are in jail right now on inflation and monetary growth. They get out the jail card because of a potential European recession. I mean, a European recession could be an excuse not to tighten as aggressively as they normally need to. But so I think if there are no negotiations between the West and Russia on the status of Ukraine as a potential future member of NATO, then I think we have a very volatile period coming up in markets. It's going to be an extremely volatile period over the next 2, 3, 4 months.
Since, what I could gather from what you said is that India is well placed among the emerging markets as far as the economy side is concerned. What happens to the FII flows? I mean, the FIIs have been shying away from last 1 year. They have been pulling out money from Indian subcontinent. Would they be returning anytime soon if situations, prove to be better from where we are right now?
Well, I would expect that FIIs will pay attention to valuations, and valuations in India are not all that out of line with historical trends. The interesting thing is that certainly approximately a year ago, valuations in India looked rather rich, but India's earnings performance has been very good over the past year. So corporate earnings have been good. EPS growth, consequently, for the broad market has been reasonably strong. And so valuations are beginning to look much more reasonable now.
Okay. And
the prospect is for India's economy to do quite well in the year ahead. And consequently, the performance, the EPS growth performance should remain reasonably good going forward. And so I think that we'll begin to see some net inflows from FIIs within the next 2 or 3 months. We'll begin to see FIIs take more interest, given relative valuations. I mean, if you look at the US, the cyclically adjusted PE ratio is at extremely high levels. But it's also worth noting about that there's a so-called a hedonistic factor here, which is that within the S&P 500, the technology sector has a growing weight because it's a market cap weighted index, and the five firms have a huge weight, growing weight in the S&P 500 index, and so they are seemingly distorting the cyclically adjusted PE ratio for the broad US market. So that is one mitigating factor. But even taking that out, US valuations are at unusually high levels, and relative to that, I would say that India is actually looking more reasonable, and consequently there should be more interest from FIIs in the Indian market, by the middle of this calendar year.
Let's talk about the GDP estimates. Now, you have economic survey mentioning GDP estimates for 8.5% for FY23, RBI projecting it somewhere between 7.8%, and government nominal GDP forecast at 11.1% for FY23. Is this caution really warranted given the uncertain nature of the global economy and the geopolitical situation that is arising? What are your estimates like?
Okay, my estimate for real GDP this year, I estimate in the current fiscal year 9.6. I'm above consensus.
Yeah.
For next year, I have 8.4. Now, it is this is pre-Omicron and so on. So it is possible that instead of 9.6 this year, we'll get something closer to 9. But if you get a lower base like 9 this year, then for next year, my baseline is 8.4, but 8.4% real GDP growth. If this year's base is lower, if you have, if growth this year turns out to be closer to 9 rather than 9.6, then next year's growth will be stronger. And it's simply a base effect, because if you think about the first quarter of FY22, it was hit by the second wave.
Yes. So
the second wave depressed real GDP. Had it not been depressed, then we would have got growth of more like 33%. We actually got nearly 10 percentage points of growth taken off by the impact of the second wave. This year, there will be no similar disruption during that quarter. So the first quarter of the fiscal year will be very strong in terms of growth, because it's relative to a depressed base on a depressed base. 2 years of depressed base in that quarter. So if you just have the economy functioning normally, you'll get a very, very strong quarter, the first quarter of the fiscal year, next fiscal year. The RBI estimate is for growth to be below 5% in the second half of FY23. I don't think that will happen. I think that we will begin to see a recovery in private investment, which has been quite depressed for the last 5 or 6 years. So there is a pent-up need for private investment to rebound. I don't think you'll automatically get a crowding in of private investment just because public investment is growing. No, that doesn't happen. If you get public investment growing strongly and the fiscal deficit also rising to 6.9% of GDP as estimated by the government for this year, and then 6.3% of GDP for next year. If those are really the numbers for the fiscal deficit, then there won't be much crowding in a private investment, I'm afraid. But the reality is that in the current fiscal year, FY22, the actual fiscal deficit will be more like 5.6% of GDP or less, because in the first 9 months of the fiscal year, revenue receipts had already hit 97% of the full year budget estimate. They've since revised up. The revised estimate is a little bit higher, but the revised estimate assumes implicitly that in January to March, we'll only get 16.6% of the full year revenue receipts. If you look at the last 5 years, revenue receipts in the January to March quarter were typically The worst year was 29.5% of the total for the fiscal year. The best year was last year when it was 33.3% of the full year's revenue receipts. This quarter, January to March, is always the best quarter of the fiscal year.
Okay.
So if we just take, a low number, instead of taking 30%, which is, I think, the likelier number, let's say you take a 26% increase, still below the norm of the last 5 years. Then you'll get, and you keep everything else unchanged. I keep the expenditure numbers unchanged relative to the revised estimate, exactly as the revised estimate is. You'll get the fiscal deficit down to 5.6% of GDP. So I think this year the deficit will be 5.5 to 5.6% of GDP, and with that strong base of revenue receipts, next year there'll be much more scope. Now, the government has penciled in 11.1% growth in nominal GDP.
Right.
Extremely unlikely. Nominal GDP next year will probably grow close to 14%, 13.5%, 14%. And so if that's the case, you'll get better revenues, much better revenues than what is projected in the budget. So now, the momentum of corporate tax revenue, personal income tax revenue, GST revenue, customs duty revenue, all are very strong. And there's no reason for them to suddenly tail away into next year, especially given that the first half of the fiscal year is going to be very strong for growth for all of the sources of tax revenue growth. And so we'll get next year, my estimate is that in FY23, the fiscal deficit will be 4.9% of GDP. Oh. And as a consequence, crowding in of private investment will indeed occur because the government's market borrowing requirement will be a lot lower than projected in the budget. And as a consequence of that substantially lower borrowing requirement of the government, there'll be an opportunity for bank lending to pick up and gain momentum over the course of the year. And as that happens, we'll get a crowding in of private investment. So public investment, of course, is already budgeted to be picking up strongly. Yeah. And yet the fiscal deficit will be lower. And so there will be room for a crowding in of private investment. This is essential, of course, for the medium and long term as well. It is essential for private investment to revive so that we get a new cycle of investment-led growth over the next few years. There's a tremendous opportunity here in that the global backdrop has turned quite favorable to India. The two administrations, one Republican, one Democratic in the US, have committed themselves to the Indo-Pacific as a strategic concept. And more importantly than that, they have also committed to making India the base for global supply chains. And so that combined with the production-linked incentive scheme, I think is creating an environment that is conducive to a real pickup in manufacturing investment. Now, if you just think about the manufacturing investment environment, apart from all this, new manufacturing units will pay an effective tax rate, including the supplementaries, etc., effective tax rate of 17%. Now, when I think back to our Shastras, the tax rate that was considered what a Dharma Raja was supposed to tax was 1/6. Okay. So finally, at least manufacturers will be paying the dharmic tax rate. They will be paying almost just marginally above the dharmic tax rate. Okay. Now the rest of India pays too much. I mean, frankly, to have a 41% is adharmic. It is completely against our dharma to have a 41% tax rate. But also, I mean, on the other side, if you think about the corporate tax rate, there's a 22% corporate tax rate now. With all the supplementaries, etc., is 25%. Now, that tax rate is highly competitive with the rest of the world. It is highly competitive with the rest of Asia. So, given this environment, the fact that the corporates now in India are paying a tax rate that is comparable to the lowest tax rates in the rest of Asia, and that new manufacturing units are paying, an extremely low corporate tax rate. Plus, they're getting the production-linked incentives. I think the government has now done all it could to induce a new boom in investment spending. And hopefully that boom in investment spending will come through, and we'll begin to see. Now, if you think about the Indian economy, it's quite interesting that India is the world's second largest producer of steel, aluminium, cement. It is under normal circumstances, the fifth biggest producer of cars and vehicles. It is the fifth largest oil refiner in the world. So it isn't true that India has had no industrial revolution. India has had something of an industrial revolution, but it's somewhat narrow. The problem with India's industrial revolution is that two things are missing. Two big engines are missing. One is labor-intensive manufacturing. When the multi-fiber arrangement was dismantled 28 years ago in the Uruguay round of WTO, what is called GATT and then became WTO, that was an opportunity for India and other potential producers of textiles and garments to really ramp up. But that opportunity was taken almost entirely by China. India missed the boat. In recent years, over the last 10 years, the opportunity has been picked up by Bangladesh and Vietnam. Yes. India has still missed the boat. Now, there is still, I'd say in Uttar Pradesh and Bihar and across the north of India, there's still a tremendous amount of surplus labor available that could be employed in large-scale textile, garment, shoes, toys, and food processing industries. Large manufacturing plants can be set up. The new labor codes provide some of the basis for that to happen, but we probably need a little bit more. And once that happens, then we can begin to see a real labor-intensive manufacturing boom. That's one side. The other missing part of India's manufacturing sector, the second part of the engine that is missing, is electronics. The entire electronic space is something that Southeast Asia and then China has taken full advantage of. And of course, before that, there was Japan, Korea, Taiwan. Now, India is beginning to really focus. I mean, this government has tried all kinds of incentives in the last 3 years. I'm afraid those incentives have done only a little bit so far. What you find is that electronics exports are now 4% of India's exports. I mean, it's better than zero, but it's still only 4%. And in the last 4 years, in 3 of the last 4 years, you've had spectacular growth in electronics exports. But it's still a very small, even if you look at the electronics output numbers, they're beginning to show some improvement. But the share of electronics in manufacturing is so small that it barely makes any impact. So, there are some announcements. We saw that recent announcement of Foxconn and Vedanta getting together to do semiconductors. Now, Foxconn is not really a semiconductor behemoth. If you want a semiconductor behemoth, you need to get another Taiwanese company, TSMC, Taiwan Semiconductor Manufacturing Company. You need to get them to come in, or their rival, UMC. If you can get those types of really big players to want to put up chip manufacturing plants in India, or if you want to get Intel or AMD, the big American producers, to really look into India as an alternative to, so Intel, for instance, has been in Malaysia for the last 30 years. You could easily induce them to move some of that to India. So so the missing parts of India's industrial revolution are the two extremes. One extreme is labor-intensive manufacturing. The other extreme is tech-intensive manufacturing. If you can get those two engines to join the engine of resource intensive, if you look at steel, aluminium, oil refining, car manufacturing, and those are areas where India has already done reasonably well, but there is now scope to widen it further, and so I think the incentive structures and so on in place, that keep getting refined and improved upon year after year, I think have now created the environment for a genuine broad-based industrial revolution to take off in India.
But more would depend upon the execution part, sir.
Of course, execution is always the key. And with regard to production-linked incentives, I think it's very important to have a mix of carrots and sticks. The successful countries of East Asia, Japan, South Korea, and Taiwan, had carrots and sticks. And the stick was that if you didn't meet export targets, production targets, etc., the incentives were immediately withdrawn. And that discipline was required. And so in administering these production-linked incentives, it's going to be very important to ensure that we have not only carrots for success, but also sticks for failure. And the sticks are, India is not good at these sticks. I have to say, India has never been very good at giving an incentive and then taking it away. No. When we started our, the Nehruvian policies of protecting the entire thing and having this license control Raj, there may have been a reason to do it for maybe 5 or 10 years, but then you have to withdraw it. India kept them in place for 40 years. And that is the problem. So if you look at, say, South Korea and Taiwan, they also had some protection in the late 1950s and early 1960s, but they withdrew it quickly because the argument was you need infant industries to be able to grow. But an infant cannot be an infant for 40 years. Then he becomes first an adolescent and then a middle-aged, paunchy person with no ability to move. So that's, so that is the problem. So execution, absolutely. I mean, the execution is the key, and it is the ability to not only offer the punch bowl, but also take it away that is required to have true success with these policies.
One last question, Mr. Basu. Is there a possibility of a downside risk for FY23 consensus earning forecast for companies once the commodity-led upgrades lose steam? Because there was a time when we were talking about commodity being in a super cycle. Things are going to be buoyant for another 4 to 5 years for commodities. That's here to stay. But things are changing slowly.
No, I don't think we are in a commodity super cycle. Far from it. This is the commodity super cycle of 2003 to 2011 was driven by China's boom. It was driven by the fact that China was going gangbusters. And it is not possible for China to have another such boom because China has overcapacity in all these industries. If you look at steel, cement, aluminium, cars, solar panels, you name it, and China has overcapacity.
Yes.
So if you look at China's story over the past year, since May of 2021, fixed asset investment in China month on month has actually declined every month. So that to me is a sign that the Chinese economy is finally succumbing to overcapacity. So if there's to be a super cycle, there won't be. Firstly, there won't be. But if there is to be a super cycle, it'll be generated by India. So in the sense that India will have to have a capacity building boom in these industries, in the old industries of steel, aluminium, etc. India is already the second biggest producer.
Mm-hmm.
But if you just look at, say, steel, right? It's true of aluminium as well. China accounts for more than half of world production and consumption.
Yes.
It is not possible for one country to be producing so much year after year. It's done that for the last 10 years. It has accounted for more than half of world production of steel and aluminium, and also steel consumption. There's something, there's enormous overcapacity there. And that overcapacity is exerting downward pressure on the rest of the world's ability to invest. And the single biggest sufferer from that is the next biggest producer. I mean, India, under normal circumstances, should be seeing a huge increase in investment in steel, aluminum, etc. Now, we've recently heard that ArcelorMittal and its partner, Nippon Steel, was largest and third or fourth largest steel manufacturing companies are getting together to create 24 million tons of steel capacity in Odisha, in one state. Mm-hmm. 24 million tons is 20% of India's capacity right now. No country other than China has ever produced more than 128 million tons of steel in a year, ever. Mm-hmm. India is at 120 million. I think if anybody can, India can increase its output of steel and capacity by, can double it in the course of the next 10 years. It is possible, but one has to ensure that cheap steel isn't dumped from China into India.
Right.
And there is a strong possibility of that continuing to happen. So, ArcelorMittal and Nippon Steel know what they're doing. It took Lakshmi Mittal an entire lifetime to put any money to work in India. Remember, he first went to Indonesia, Mexico, Trinidad, Germany, East Germany, Kazakhstan, all over the world.
Yeah.
But only at the end of his career has he come to India. He bought SR Steel. So the fact that he is now considering a massive ramp up in output in India is a good sign. But at the moment, it's still a sign. He has only said he's going to do it. Remember, POSCO, Pohang Iron and Steel of Korea, had planned 12 million tons in the same state. So there is many a slip between the cup and the lip when it comes to investing in India.
Thank you, Mr. Basu, for sharing your views on the macroeconomic scenario and the way forward. Thank you so much for your time.
Thank you so much.